Funding for Market Journal is provided by the Nebraska Corn Board.
When we transform Nebraska corn into ethanol, it doesn't disappear from the food supply. It just takes a little detour. Ethanol is made from the starch. The rest of the corn becomes livestock feed to create meat and dairy products, corn oil, sweetener, and other food ingredients, and maybe a little carbon dioxide to make your soft drinks fizzy. Homegrown ethanol helps satisfy America's hunger for energy and the world's appetite for feed and food. Nebraska's family corn farmers, sustaining innovation.
Market Journal, television for agricultural business decisions, is a presentation of the University of Nebraska-Lincoln's Institute of Agriculture and Natural Resources. Promotional support is provided by the Nebraska Farmer Magazine, and major funding for Market Journal is provided by the Nebraska Corn Board.
Welcome to this week's edition of Market Journal. I'm Jeff Wilkerson. On this episode, Derrell Peel looks at American beef exports. Ken Hellevang describes how farmers can maintain good quality in stored grain. Tina Barrett explains how possible tax reform could impact farm operations, and Al Dutcher gives his weather forecast for the coming week. Oklahoma State Extension's Derrell Peel is our cattle market analyst this week. The U.S. produced a record amount of red meat for the month of September and 2% more beef than a year ago. As you'll hear in a few minutes, that excess output has been supported by demand both domestically and internationally. American shipments of beef and veal in August logged their highest total in more than 4 years, led by Japan and its best month since October 2003. The U.S. Department of Agriculture is projecting exports for 2017 will be 11% better than 2016, but still below the world's top 3 sellers. The agency's latest cattle on feed report indicates supply should be plentiful. The overall inventory at the beginning of October was 5% higher than last year, and placements during September were up 13%. We talked with Derrell Tuesday morning about market prices and beef trade, but we began by asking for his thoughts on the USDA's cattle on feed estimates.
Well, obviously we've got more cattle out there. We placed a lot more cattle in September, and that pushed the on-feed inventory up to a little bit over 5% year over year. Placements were pretty close to expected, but marketings were pretty close to expected, but that placement number was certainly bigger than generally anticipated.
It's not the first time that the pre-report guesses on placements have been lower than what the actual number turns out to be. Why has there been such a hard time deciding where the number is going to come in?
Well, placements are always more challenging to estimate. We have the widest range typically, and these estimates did fall within the range of a couple of analysts in terms of published pre-report estimates. So it wasn't a total surprise, and I know amongst analysts there was quite a bit of talk going into the report that the number was going to be bigger, but there was a lot of variation in sort of feelings about how much bigger. So in one sense, it really wasn't that big a surprise. I don't think anybody was, really startled that this one came in bigger than even the average estimates. It's difficult, especially as you think about different regions of the country and who's placing cattle when and what size of cattle and so on.
And the market reaction was fairly tame?
It was, surprisingly, after some of the reaction we've had in recent months, and the fact that we've had a real strong run-up recently over the last several weeks in futures markets. I thought we might be poised for a bit of a correction based off this report, but the reaction actually seemed to be pretty mild. I think the market's kind of taken it in stride.
Surprised at overall how well prices have held in here?
Really am. I think in a very big picture since 2017 has been a pleasant surprise. Certainly this fall, as we've looked at feeder cattle prices, they've held up very well. Calf prices, at least in Oklahoma, have dropped less than half of the normal seasonal amount, really very little at all. We may see more pressure here in the next few weeks before Thanksgiving as we get into the fall run, but feeder cattle prices are actually higher now than they were, say, back in August. Counter-seasonally, and so they've held it very well. Of course, that speaks to the demand that feedlots had in terms of those big placements in September.
Can you explain what kind of environment this price scenario creates for cow-calf producers or stockers?
Well, I think given where we are right now, cow-calf producers are looking at, probably better than expected prices, and I do think there's an opportunity for some decent profitability. Obviously, there's a challenge here to manage costs. The margins are not big, but I think there's certainly potential for margins for those producers that are staying on top of their costs. For the stocker producers, even though calf prices and the purchase prices have stayed fairly high this fall, given the strength we've had for the futures markets and feeder cattle prices in general, there's actually decent margin opportunities here for stocker producers as well, and an opportunity really to lock that in and reduce some of the risk associated with these stocker enterprises over the winter.
In the feedlot, are there opportunities there as well?
Surprisingly, they've held up reasonably good. Margins have certainly tightened up here in the second half of the year for feedlots. They have bid up these feeder cattle prices, somewhat squeezing margins, but again, the strength in the live cattle futures for the spring has come at least close to providing a decent opportunity. Again, there's variation from feedlot to feedlot, so that's helped them go ahead and support these stronger prices. I think there's probably a lid on feeder cattle prices relative to fed cattle potential here, or feedlot potential, but so far it comes pretty close to working.
What does the competition look like here in the U.S. with meat demand when it comes to beef versus chicken versus pork?
Well, we know there's ample supplies out there. Obviously, beef's kind of leading the way right now, but pork production's up. Poultry production is up, not too much, perhaps, and we've shaved it back a little bit as we've gone through the year. But the bottom line is there's ample supplies of meat out there. And from a beef standpoint, I think the demand has clearly been the key in 2017 to making it a better than expected year. We've seen these retail beef prices hold very well. For the most part, wholesale beef prices have held pretty well. They did slump during the summer and have recently started to rebuild a little bit. And again, that has been somewhat of a surprise given the opportunities there are for other meats in this market.
Well, and foreign demand has been really strong too, right?
Absolutely. Our trade picture has continued to support the domestic market. It's moved a lot of the increase in production offshore, with about a 14% increase for the year to date in exports in total. We were up about 12% last year. So the exports continue to help. Imports have been down most of the year. The last couple months we've actually seen year-over-year increases on a monthly basis. So we're narrowing down that, but the net effect here is still very positive on the trade picture.
Can you explain why Japan has been able to hold in strongly even though there's higher safeguards in place for frozen beef there?
Well, we didn't really know what to expect with the higher tariffs in Japan for the frozen beef. Well, one question was how much we could switch around between frozen and fresh beef, which wasn't subject to the safeguard tariffs. That's one issue. The other one is we just really don't know how strong demand is. So you raise prices, you expect some impact, but apparently the demand is such that at these levels we still don't see a lot of impact, at least not yet.
Well, describe for me the overall world trade for beef, the other competitors that the U.S. is going against.
Well, the global situation, obviously, in terms of exporters, India and Brazil are the two biggest. Australia's number 3, the U.S. is number 4, and that's the way they're projected to go for 2018 based on the latest Foreign Ag Service estimates. India and Brazil are very close to tied. India has been the leading exporter the last couple of years. With some of their internal issues in India, they've sort of flattened out. They're kind of holding steady, not seeing the growth that we had seen before on the exports. Brazil, of course, has had some issues as well with their food safety problems and some of their other corruption issues in the industry there. So both of those are kind of holding steady going forward. The U.S. is expected to continue to see some growth, at least modestly, in exports as we go into 2018.
To close out with, I'll ask for your price forecast here back in the U.S.
Well, I think in a general sense, as we move into 2018, we know on the supply side that we're going to see increased beef production. That's going to continue to apply that pressure. And so I guess our overall expectation for cattle prices, both feeder and fed cattle, is what I would call modest price declines, probably in the range of plus or minus 5% or 5 to 8% perhaps. Not terribly, not huge discounts or a huge need for adjustment as we go forward. It really hinges on the demand. If the demand continues strong, we can hold it to that or perhaps even keep it to less than that. But if we should see any faltering in demand, either domestically or internationally, then we're subject to more downside risk because the supply pressure is certainly going to be there through 2018 and really all the way through 2019 into 2020.
Next week, Luke Beckman from Central Valley Ag will join us to look at corn and soybean markets. Over the past week, Nebraska farmers made significant advances bringing in the 2017 crop. USDA's latest progress report shows soybean growers are now 2/3 complete with harvest, double the amount they were the previous week. The state's corn producers are just more than a quarter finished. Over the past 5 years at this point, they were half done. To discuss storage considerations for that grain over the short term and long run, we recently talked with North Dakota State Extension Ag Engineer Ken Hellevang. We started by asking Ken for some general rules of thumb when it comes to storing corn.
Well, storing corn isn't really any different than storing any of our other types of grains, and so we come back to the fundamentals. We need to make sure that that grain is dry, at least dry enough for storage for the period of time that we're expecting to store it. And then we need to be concerned about the quality of that corn. Are we starting out with whole kernels? I'm getting some reports that we're seeing more breakage of the kernels this year. That's going to make it more susceptible to harvest losses and storage losses. The other thing then is making sure that we're controlling the temperature, cooling that grain as rapidly as we can to enhance the storage life.
When you see problems with storage, how do they generally occur?
Well, we'll typically encourage farmers and storage managers to monitor grain temperature. And by following that grain trend, we can sometimes pick up when we're starting to have storage problems. Another tool that is relatively new on the scene is monitoring the carbon dioxide level. And both insect activity and spoilage produces carbon dioxide. So by monitoring that within the storage, we can kind of get an indication. Still go back to the old, go in there and look for insects, look for indications of crusting, look for moisture condensing on walls, the typical things that we've been doing for years.
How does crusting occur, Ken?
Crusting typically is going to occur either because we're having moisture dripping off of the roof back onto the top of the corn pile, or we end up with a temperature variation within the grain mass. If we're not cooling the corn as the outside temperatures cool down, we get convection currents that then create that moisture accumulation in the top of the bin.
Is there a maximum amount of time that you can be storing this grain? And that probably is applicable to any corn that might be left over to last year too.
There really isn't a maximum storage time if our management is up to par. That means that we need to be making sure that the corn has been dry, and for long-term storage we're really thinking of 14% moisture or less, preferably down in that 13.5% moisture, and then making sure that we're keeping the grain cool. If we have it dry, have it cold, then we can store multiple years. But storage life is cumulative, so if we use up a fair amount of that storage life because the moisture contents are too high, grain temperature becomes too warm, then we're looking at maybe just a little over a year or even less than a year, depending on conditions.
What should your expectations be about storing grain outside in a pile?
I really discourage trying to store corn or any type of grain in a pile. Just a 1-inch rainfall on a pile, if we're concentrating that in the top foot, will raise the moisture content by 9 percentage points. So we can start out with 15% moisture, just a single 1-inch rain, and we're up to 24, 25% moisture and problems. So anything that's going to be stored in a pile needs all of the same principles that we think about for any other storage. Aeration, prepared surface, some type of cover over the pile to keep the moisture out.
Ken says soybean storage guidelines are similar to other grains, except moisture should be kept at 13% through winter when outside temperatures are colder. However, he urges growers to lower that moisture to 11% if they intend to store the beans for a longer period of time. President Donald Trump says he wants to reform the American tax system and would like to see legislation to do so before the end of the year. Because there isn't a definitive plan, specific details are unknown, but there have been proposed changes that could impact farm operations, including eliminating many deductions and new tax rates for corporations and small businesses. Earlier this week, Tina Barrett from Nebraska Farm Business Inc. joined us to give an overview of possible changes. We started by asking about the idea of narrowing individual income tax brackets from 7 to 3 and whether that would help ease tax preparation.
So, a lot of times people think that's a big simplification, but really it's just a math formula. So we're talking about less brackets. Their proposal is a 12, 25, and 35% rates. But what the proposal doesn't tell us is where those breaks are going to be. And so it's hard to know exactly what kind of impact that will have. Yeah, it's a simplification, but it's not huge either to not have all those brackets. But
let's talk about some of the other changes. One would be increasing the standard deduction and eliminating the personal exemption. This would do what?
So this actually would simplify things because the personal exemptions are those deductions that you get for each person in your family. And sometimes we do have complications of defining whose child it is, who gets that deduction, all those kinds of things, especially in divorce situations or other situations like that. So that actually simplifies things. They're going to double the standard deduction. So really for a family of 4, it's pretty much the same. Okay, well, 3, somewhere between 3 and 4 it breaks. For families like mine with 4 kids at home, there's 6 personal exemptions. This would be a tax increase for our family. So it really just depends on your size of your family and where you're at.
But there would also be changes to the child tax credit?
Right, that's the other proposal is for those kids who are under the age of 17 at the end of the year. Right now we get a $1,000 child tax credit for that. The proposal just says to increase it. We don't know how much of an increase, but this is a credit rather than a deduction. So a $1,000 increase in the child tax credit would pretty much equate to a $4,000 deduction for most families. So it kind of goes back and forth. They also said they would increase the limit for income, who gets to take that. Right now, if your adjusted gross income is over 110, you don't get it. And so again, no number there, but depending on how high that goes up, that could encompass quite a few more families.
You said one thing that could help simplify things is eliminating the alternative minimum tax, the AMT. Why is that?
Well, so it's just a complex part of the tax code that was put in place a long time ago. And we've talked about it several times because they didn't increase the place where it would kick in for inflation. And so they've brought that up, but it's still something that hits a fair number, a significant number of farm returns that we prepare. But really what it's there to do is to keep high income taxpayers from taking too many tax benefits. And at the time it was put into place, they were talking about the top 5% of tax preparers, and now are encompassing a large percentage. So it would go a long ways to eliminating that and helping out a lot of farms. Describe
the potential changes to itemized deductions.
Yeah, so that's a big one, and again, we've heard a lot about that one, but what it kind of sounds like they'd like to do is eliminate a lot of those itemized deductions, keeping just charity and the real estate taxes on your house. And so it would reduce the number of people who are itemizing significantly. So, there's a lot of itemized, there's hundreds of itemized deductions that are on there. Eliminating those, again, goes a long ways to simplifying things. The potential downside, though, is that, if people are giving to charities just for the deduction, is this going to potentially harm those charities as it goes through? So that's another unknown.
There has been some talk about eliminating the estate tax, otherwise known as the death tax. Do you think this is something that could help on the farm?
The estate taxes really affect a fairly small number of producers, especially with some planning. We can keep a lot, certainly the vast majority of farm operations free from that estate tax or significantly, with a smaller amount. But it does impact farm operations. And again, not in the proposal, but the last time they talked about eliminating the estate tax, it was paid for by taking away the step-up in basis. And that's a huge thing. That's something that every farm operation takes advantage of it and really provides benefits. And a lot of times we hear that we don't need to step up in basis because I'm not going to sell the ground. But we need to think about the fact that we get step up in basis in equipment, we get a step up in basis in the grain that an active farmer has. and that livestock, and his heirs can either sell those assets free from income tax or start redepreciating that equipment, use that deduction on their return. For most operations, that's a better gift than elimination of the estate tax. So we got to figure out what we can do. If we could eliminate the estate tax and keep full step-up in basis, great. But with budget issues the way they are, it seems highly unlikely.
How might the tax rates change for small businesses and corporations?
So the proposal has for individuals, partnerships, and S-corps, so anybody filing a Schedule F or one of those other forms is going to be a flat maximum of 25%. So we're going to pull that down. That's pretty exciting to see happen. For corporations, though, they're looking at 20%. Now, what the proposal didn't tell us, again, is that they're keeping the 15 and then maxing out at 20 after that, or if it's going to be all 20. So it could potentially be a little bit of an increase for some producers, but I think could also open up some opportunities for planning.
When we talk on here about tax rates, it's common for us to talk about Section 179. It's because usually we don't know what that amount is going to be, but now that could be moot.
Right. So, we've talked for years about what it's going to be. Now the proposal is to make it unlimited, but the proposal has a few words in there that scare me a little bit that says for at least 5 years. And we don't know what it'll be at the end of that time. Will it go back to $500,000? Will it go back to $25,000? Will it be gone altogether? And what I really would hate to see is that back to that unknown, because right now it's permanent index for inflation, so they have to change the law to change it. And really, for most farm operations, $500,000 is pretty close to unlimited. And so, I think if there was one thing that didn't happen in the proposal, that would be okay if it didn't happen.
Okay, finally, this is perhaps one of the more followed in agriculture, the deduction for interest paid. Why is that so important?
Well, it's a strange thing to not be able to take an ordinary and necessary business expense, and why interest would maybe not be classified as that is an interesting one. And so, I think it would be a big mind shift if they do that. And, I looked at our average numbers, and our average producer last year paid about $35,000 in tax. So we're talking about a $15,000 tax hit if that went away for the average guy. And unfortunately, the ones that we're going to hurt the most are the most highly leveraged, probably working off the tightest margins anyway. And so it will be a significant impact if that happens. And so, again, it kind of rises to the top of things that we definitely don't want to see.
Tina says one of the challenges of possible tax reform is knowing when changes would go into effect and if they would impact 2017 returns. You can read more about the topics we discussed in Tina's recent Crop Watch article, available through a link on the Market Journal website. The October Nebraska Farmer says growers in Nebraska, Iowa, Kansas, and South Dakota have access to new capabilities this fall with the next line of the wheat growers' MZB precision farming system. This month's issue says Central Valley Ag, wheat growers, Landis Cooperative, and Winfield United recently announced a joint venture to help bring multiple data layers together under the Field Reveal platform. Those layers include yield history, soil maps, and aerial imagery to help service providers work with growers to build prescriptions, all while accounting for production and input costs per acre. You can read more about Field Reveal in the October Nebraska Farmer. And now with this week's weather forecast, here's Nebraska Extension Ag climatologist Al Dutcher.
Well, folks, here again for the weekly forecast. And during this last week, primarily dry weather was the rule of the day. We did have a little bit of precip in southeast Nebraska and some scattered showers around the state, isolated last weekend, but most areas, nothing in the way of any significant moisture. And all we had was basically wind shifts through the end of the week, and the big cold air that pushed through us here on Thursday afternoon has set this growing season to an end. Of course, with these low temperatures in the 20s, and now we are looking at some very cool conditions and the possibility of additional cold air moving into our region. But before we get to that forecast, let's take a look at what the La Nina forecast for this winter is. And so this is the December, January, February period. CPC calling for cooler than normal conditions to the north, warm to the south. When we look at precipitation, two bullseyes of precipitation, northern Rockies and the eastern Corn Belt. Now as we progress forward into the January, February, March period, very cold air showing up over most of the northern plains regions and the Great Lakes. And in terms of precipitation, we still say the same signal. So we do look like we will see a colder winter than last winter and potentially more snowier than we were experiencing last winter. More importantly, as we look today, it looks kind of like we're starting to see the first surges of that cold air. Big deep trough in the upper atmosphere, ridge out into the Gulf of Alaska. Arctic oscillation is in the negative phase, so that's helping to pull the cold air down into the east. high pressure at the surface. Very cool conditions this morning. We're not going to warm up much today as most of the precip stays to the east of us. Although we will see in and out of clouds, we're not expecting any precip. Then as we go to tomorrow, another front is going to start to reinforce this cold air toward the later part of the evening. Although we are showing some surface lows, it does not look like these will produce any significant moisture because the front is moving so quickly to the south. So the main precipitation band will be along the eastern seaboard with the first initial surge of Arctic air. Then we see that cold air settling in once again on Monday, so our temperatures are going to drop. And then we will see a rebound as we go into the day on Tuesday with that high pressure moving toward the southeast. We'll start to see that get to the south of us on Tuesday. So not expecting any precip Monday. And then on Tuesday, that system quickly moves toward the east. We see a little lull, and yet another system looks like it's going to bear down to us for Wednesday. So as that cold air moves into the region, we'll start to see some drying conditions, at least in the atmospheric moisture. Most of the precip stays to the south of us. Again, good days for harvest weather, but it's going to be cool. And then we start to see sort of a northwest to southeast flow, general troughing pattern starting to build into the middle of the week. That's going to allow that cool air just to stay to the north of us, and we'll be on the periphery of that cool air. So we might actually see some snowfall across the northern reaches of the country. And then the zonal flow begins to take shape with a trough moving into the Pacific Northwest on Thursday. That will keep the cold air bottled up to our north. So we're going to see a rebound in temperatures back up to more seasonal temperatures, more into the lower 60s. As we get into the day on Thursday, most of precipitation in the Pacific Northwest, the Great Lakes, and the northeastern United States. And then we see this trough starting to approach the western United States. That's going to pump up our air, and we'll probably see our warmest conditions as we go into the day of Friday. Low pressure starts to try to take shape as we get into the late day on Friday, but most of the moisture will still remain to our north and northwest. Now as we get into the period from next Thursday to the following Tuesday, we can see that another surge of cold air looks to be in the offing, and more importantly, with that big system coming in above normal precipitation over most of the northern United States, and unfortunately, based on the models, the first full week of November looks to be rather wet and potentially snowy.
Thanks, Al. Today's interviews are available individually on the Market Journal website and through the Market Journal mobile app. They include information on cattle markets, storing quality grain, and tax reform. As always, you can keep up with Market Journal during the week by following us on Twitter, Instagram, and Facebook. Next week, Luke Beckman will join us to look at corn and soybean prices, and Brent Gloy will talk about crop production costs going into 2018. Until then, thanks for watching. I'm Jeff Wilkerson. We'll see you next week.
Join Market Journal online at marketjournal.unl.edu. You can also follow us on Twitter, Instagram, and Facebook. Promotional support is provided by the Nebraska Farmer Magazine, and major funding for Market Journal is provided by the Nebraska Corn Board. Market Journal is produced by the University of Nebraska-Lincoln's Institute of Agriculture and Natural Resources.